going to go over the post-election, what's going on with the stock market, what's going on with the economy, how does geopolitics play into this? My name is Ben Reppond. Welcome to my YouTube broadcast. Today is November 19th, 2024. First, I want to talk about, when I research articles and videos on content that I want to share with you, things that I resonate with, things that I agree with, what I'm thinking, etc. As I do that, I come across a lot of information. More than ever, I am coming across videos of experts or podcasters, whatever, who are saying things like this, and I'm not going to name any one of them in particular, there's a host of them. They're saying things like, the market is going to crash in a month, or next year, or next quarter, or whatever, or the dollar is going to crash, or the banks are going to collapse, or things like this. You know what I'm talking about. If you look in YouTube, you'll find it, and maybe you've read articles like that. And so there's always that kind of information out there. But, I mean, in a way, I agree with some of that. I agree that, you know, the dollar is under pressure. I agree that the economy is under pressure. The stock market's under pressure. I agree on all that. But the big question is, when? Is that tomorrow, next quarter, next year? The people I see out there are saying this is imminent. It's going to happen right away. Well, maybe it will, but I don't agree with that. I don't think it's that imminent. I think we are in for the market. The stock market is extremely elevated. There's all kinds of currency risk and economic risk. I agree with all that. But I also think right now we're not in that period. We're in a period where equities are doing well. Bonds are under a ton of pressure, so I agree on that with bonds. But equities are doing well, economy is doing well, the dollar is at an all-time high. Yeah, I just don't see the risk right now. But I think it's prudent for investors and people who care about these kind of subjects to be prepared. And this is what I say over and over again. Be prepared to shift, or be prepared to endure the collapse that will happen from the market, the economy, the dollar, etc. That day is coming. I agree with that. But I just am not in the camp of let's hunker down and things are getting terrible right away. I just don't see it that way. So I wanted to make that comment. Today's videos, and I look through videos and read material, and I try to find things that I agree with that I think would be helpful to you. So I have 3 of them I'm going to share with you from different perspectives, totally different people, but they are all saying that the economy is doing well, the market's doing well, we have good times ahead of us. Now, a pivotal point here was the election. So Trump got elected. And the world, the U.S., I should say, the U.S. is divided 100%, right down the middle, pretty much. Half people think that's terrible, that's, you know, we're doomed, and half the people think it's wonderful. Isn't that interesting? Right down the middle. And so, but since Trump got elected, the net effect is on the market and on the projections on the economy is favorable. Whether you like Trump or you don't like Trump, or you know, you think this is good for America or not, you know, the market is viewing this favorably. So These three views, one is from, I'm going to begin with this one, Mark Faber. Mark Faber is well into his 80s, not his 70s. I don't think he's quite 80 yet. He's been around a long time, PhD in economics from the University of Zurich. He's basically a European, and he's been living, as he says, for the last 50 years in Asia and in basically Thailand. And he has a view, and his view is favorable. Now, he's taken the position of gold, that gold is going to do well in the current political environment. Interesting. It has not done well in the last week or so, so maybe it will. And he focuses a lot on precious metals and on commodities, so he probably knows more than I do, but that's his view. Now, I will say this, just so that you know, I try to take a nonpartisan view on things. I don't approach things from a conservative view or a liberal view or a contrarian view, whatever. I don't do that. So he takes, by the way, I'm just going to say this so you may pick up on it, he takes a partisan view on the effect on gold. Interesting. So I just want you to know that that's the perspective. But because I think he's also considered by many as a perma bear. He always thinks the market's going to crash. So, but he is a smart guy. He's written a lot and done a lot of videos and so forth, and I think he's worth listening to. So anyway, I'm going to play this first piece from Mark Faber and take a listen to this.
Any ramifications for gold in particular, given Trump's now in power, versus if the outcome was coming? I mean, we're already seeing a bit of a slump in the gold price last couple of days. I think latest price as of now is around 1620, which is quite a fairly sharp fall from where we were. What do you think these next 4 years, do you think the outcome of the gold price and the outcome of gold performance has fundamentally changed because of this new presidential election?
Yes, but I believe that the initial move, the downward correction, and the strength in the US dollar are actually terminal moves. In other words, they will be reversed.
Okay.
Trump, if you look at him and his personality and his history of borrowing money and never repaying his debts, it's actually very bullish for the gold price and for precious metals. Okay. So I would use, if I didn't have any gold, I have my gold already and I've had it for 40 years. But if I didn't have any gold, I would buy here on this correction.
The second video I'm going to play is Andrew Sorkin is doing an interview with Andrew Slyman from Morgan Stanley, a senior portfolio manager there, and he takes the view that it looks like we're headed into a bull market. We're into a intermediate term, maybe a long-term bull market from here. And that's his job, is to figure that out. So take a listen to this.
Welcome back to Squawk Box. Our next guest says that banking stocks have been telling us that equities are about to enter the third phase of a bull market. For now, for more on that and the markets and where it's all going, I want to bring in Andrew Slyman, Senior Portfolio Manager at Morgan Stanley Investment Management. What do you mean by that? I think this, we've been on this run. Some people think trees don't go to the sky. Others think that maybe there's a lot more sky out there.
Sure. Well, you're right, Andrew. Look, the market started to anticipate President Trump winning a month ago. So I think on a short-term basis, the market is very overbought. And, we're ripe for any bad news causing pullbacks in the market on a short-term basis. But I don't think we're going to get much of a pullback for, Andrew, 4 simple reasons. Number one is, we're in the honeymoon period where it's not reality. It's all about what the next president's going to do. And that won't happen until after the inauguration. The reality sets in. Number two, I think it is the number one period right now for corporate buybacks. and we've ended Q3 reporting, so you're going to see a big wave of buybacks between now and year end. I think positioning has been, wrong, and I think people are looking for opportunities to get in. And number four, this is probably the most important, is Andrew, in the next couple of weeks, you're going to hear a lot of strategists roll out their 2025, outlook. And if you've been bearish the last 2 years, you've either switched or you got a new job. So I think you're going to hear a lot of outlooks that are pretty positive for next year. And to your original point, that's consistent, which is, bull markets are born on pessimism, they grow in skepticism. Well, that was 23, a lot of pessimism, growing skepticism, 2024, and they mature on optimism. And that is what 2025 will be, is a much more optimistic. It's not the end of a bull market, but we're not in the early innings anymore. And I think the investment bank stocks, if you look at them, they're all telling you that we're going to have more M&A, more syndicate, more IPOs, more stock speculation. That's the normal sentiment cycle. So I don't think anything about this bull market is different than we've seen in the past.
I guess. And finally, Scott Wapner interviews Stephanie Link and Allie Flynn Phillips, two different perspectives. They also view, again, these are just different points of view. They view that they make a case for the fact that we're in for a strong stock market going forward. So I like to give different points of view. If I could find somebody who said, I think it's going to crash, I believed was credible, I would play that for you. But these are the people that came up for me that seemed correct. They're somewhat independent thinkers. They're paid to be independent thinkers. So, but take a listen to this with Scott Wapner, Stephanie Link, and Allie Flynn Phillips.
And let's broaden the conversation, if we could, with more guests. Stephanie Link of Hightower Advisors, Allie Flynn Phillips of Obermeyer Woods. Steph, a CNBC contributor. Allie, it's great to have you here with us on set. What do you make of what the professor has said?
Well, first, it's great to be here. The professor brought up a lot of very good things. I mean, one thing, even with this week, 2024 has been an incredible year. It's really been so because you've had this soft economic landing, lower interest rates, and really solid earnings in both technology and other sectors. So first, we would really pause on that. Mm-hmm. The other thing is history has our back. So if you look at presidential time between inauguration days and presidential elections, for the last 50 years, there's only been 2 times when the market's been down. And that was 2000 and 2008. And that was when you already were in a recession and a severe bull market.
How much do you think we've pulled forward, though, because the burst was so sudden and big? Now, it's cooled off, obviously, this week, but we did have a pretty large pop off of the result of the election.
We did, but to us, that was more of a relief rally. It wasn't necessarily an endorsement of the new administration's policies. It was more the fact that you actually had a fair election. You actually now have certainty, which is good. So from that point of view, is we think this pullback actually is quite natural this week. Again, like the market got a little bit rich, we're back to something more normal. Mm-hmm. But the key thing more than anything is picking your spots, finding great opportunities going forward where you have trends that are not based purely on administration, but really in terms of long-term trends and really good companies.
Steph, what do you make of those points of view?
Yeah, I think I agree with a lot of it. I think that, look, the market is digesting what the Trump administration, what does it mean for growth? What does it mean for inflation? And now you all of a sudden have a Fed that's probably going to be much slower in terms of rate cuts. Here we go again, right? I mean, I can't believe we didn't learn our lesson back this past year. When we started in January, everyone was thinking 7 cuts. So we have to just kind of digest that. That all being said, Scott, we're still up 2% in November, both the NASDAQ and the S&P 500. So you're still having a pretty good month. I think that there's a big misinterpretation in terms of the inflation data. I mean, I think, yeah, the core CPI and the PPI in the 3s is not great, but it's because we are growing faster. And I will take faster growth and a little bit more inflation from an investment point of view any day versus the reverse, because that gives companies pricing power and it also helps the margin story. And if you have a mid-single digit revenue growth in a 2.5% GDP world and margin expansion, you can get to 8 to 10% earnings growth for this year and also for next year. So I just think we have to just settle down and realize we're growing faster. We have a little bit more inflation. Maybe the neutral rate is at 4.5%. We can live with it because, by the way, we have a consumer that just won't quit. I mean, those retail sales numbers this morning, if you think about it on a year-over-year basis, running up 4.6%. You had an ISM services number about a month ago, near 60. And this is really a good time for the consumer, even in the face of higher inflation. And so I think, you want to pick your spots for sure. I love that we're seeing the broadening out. I mean, the Russell 1000 growth is actually down 2% today. The Russell 1000 value is only down 40 basis points. And so you are seeing an expansion into participation. And I like that.
Okay, well, thank you for watching. If you have questions or comments, leave them in the comment section below.